أعوذ بالله من الشيطان الرجيم أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله صلاة والسلام على رسول الله. Chapter 7. This is on fraud, internal control, and cash. Right. So let's talk about fraud a little bit first. There are three factors that contribute to fraud. When these one or more of these factors are in play, fraud becomes easier. The first one is opportunity. Opportunity is the gateway that is open for someone to do the fraud. The lock is open. You can go and you can get the money. There is no password protection. You can get the data that you can sell outside. So there is an opportunity. There is an open gate. Nobody's watching. Nobody's looking after your work. Nobody's reviewing what you're doing. There is an opportunity. You have the chance to do it, right? You have the chance to do. The second problem, the second factor is financial pressure. So people feel there is a perceived, this is perceived, not necessarily a real pressure. People might feel that they have to drive a certain car because their friends are driving or their relatives are driving a particular type of car, or they have to maintain a certain lifestyle because their friends or relatives or cousins, etc. So people feel it within themselves, or spouses could put, the husband could put pressure on the wife could put pressure on the husband, your family could put pressure on you, etc. So there is a financial pressure to get something that does not belong to you. And then the third one is rationalization, which is the false justification that you give yourself, that someone gives themselves, that it's okay to do because everybody's doing it, or it was owed to them, or the company did not treat them properly, etc., etc., etc. There could be a host of things that people could tell themselves and falsely justify what they're doing. So in one or more of these things, when it's available, fraud is possible. Now, every company is aware of all of this. So every company tries to put in place what is called internal control. Internal controls are procedures. We'll talk about more on internal control in a slide. Internal controls are procedures that minimize the fraud, right? That minimize the fraud. And after the Enron scandal, you are old enough to remember, I think, Enron, there was a scandal in the early 2000s, not just Enron, number of scandals, Enron, WorldCom, and some other companies that were involved in some malpractices when it came to accounting. And because of that, the public lost trust in the accountants and auditors, because one of the largest firms, Arthur Andersen, was involved in auditing those companies, some of those companies, Enron especially, and they allowed the company to record certain financial transactions and present certain things in the financial statements that they were not supposed to report, that were not true, that were not following the guidelines. Some future sales which had not occurred were recorded in years prior to those sales. I mean, who knows about the future sales? Nobody knows. Even if you know, you cannot record the sale until you have satisfied the service or the goods to the customers. Even if the customer pay you before you provide the service, you cannot record sales. What do you record? Unearned revenue. So future sales, projected sales, you know, every accountant knows you're not supposed to record that. But, you know, somehow those people recorded them thinking that they will not be caught. It was called, you know, they wanted to smooth out the sales among the years because they had a new product and they thought the sales would shoot up really high in the following year. They recorded some in the previous year to kind of smooth it out. Again, this is fraud, this is unethical, and they were gone. So following, excuse me, following those scandals, there was a act or a set of rules that were put in place called the Sarbanes-Oxley Act. Sarbanes and Oxley are the last names of two senators, US senators, who drafted this document, and it applies to publicly traded companies, companies that sell their stocks in the stock market, and they are required to maintain a system of internal controls, right? We're going to talk about internal controls. This Sarbanes-Oxley Act required many things. One of those things was to impose certain procedures, internal control procedures, to minimize and detect fraud. And the responsibility of corporate executives and board of directors were to ensure the reliability and effectiveness of these controls. So the corporate executives, the CEO, CFO, and the other executives, and the board of directors, their responsibility was to make sure that those controls were reliable and effective. And the outside auditors, the independent auditors, came and they checked, they still do, they check the internal controls of the company, and in addition to giving an opinion on the financial statements, that the financial statements are reasonably accurate, they give an opinion on the quality of the internal controls. So the internal controls are certain procedures, and we're going to talk about in the next slide what exactly they are and what are they supposed to do. The independent auditors are supposed to give an opinion on how good or bad the internal control is, okay? And to oversee that all of this is happening smoothly in the publicly traded corporations, a oversight board, it's called the PCAOB, Public Company Accounting Oversight Board, was created. Sarbanes-Oxley Act is called SOX in short. SOX refers to the Sarbanes-Oxley Act. It's available online. If you ever have trouble sleeping at night, you can print and start reading it. This created the Public Company Accounting Oversight Board. Is out there policing that the corporations are doing what they're supposed to do, the auditors are doing what they're supposed to do, they issue new pronouncements every now and then, right? One of, they have, highly qualified people working for them. There was an accountant who graduated from the same university I graduated from, undergraduate institution, the University of South Alabama. He worked for the same CPA firm I worked for, and then he is like a few years behind me. So 3 years later, after I joined the PhD program, he joined the same university, the PhD program that I was in. I was in last year, he was in his first year, and his name is Saad. He joined PCAOB after completing his PhD. So you can see they hire, qualified individuals to research and to oversee the practices that the companies and the auditors are involved in. Okay, so what is then internal control? Internal controls are a set of measures and methods that ensure, number one, safeguarding of assets, right? To protect the assets from getting misused or stolen. And there are specific mechanisms we're going to talk about, right? Going to give you many internal control, examples of internal control. They are in place to ensure the safeguarding of assets so that any assets are not misused or stolen. Enhance accuracy and reliability of accounting records as well as the financial statements. There are procedures in place, right? For example, hiring qualified accountants, reviewing their work, making sure that the guidelines of accounting and reporting are followed. All of these are controls, internal controls to ensure the accuracy and reliability of accounting records. The third objective of the internal control is to increase efficiency of operation, right? To make sure that the operation is not just efficient but effective as well. So there is a small difference between effectiveness, or it's a large difference. There is a difference between effectiveness and efficiency. Effectiveness is to do the right thing. Efficiency is to do it without any waste, right? So if you have a cup of water, you have to make with it. Effective is to make sure that every part that you're supposed to wash becomes wet. That's effective. Efficient is you do it with a small amount of water, no more than what is needed. That is efficiency. So in every action in the company, the question to ask, and you will come across this in other courses as well, the question to ask is this activity value added or not? Meaning, if I did not do this, would there be any difference? Does it make a difference for anyone or anything, any procedure? Does it make any difference? If I stop doing this, is there going to be any harm? The second question is, if I do it, is there any benefit? Right? If both of the questions are answered with a no, that means this is a non-value added activity. There is no need for doing this. It's a waste of time and energy. Are you following? And in many cases, resources, right? You may need a room to do it. You may need a couple of computers to do it. You may need a machine to do it. So if you don't need to do it, then that's waste that is inefficient, right? So effectiveness is doing the right thing. Efficiency is doing it using the least amount of resources. Number 4, ensuring compliance with laws and regulations. So internal control's objective is to also ensure that the rules and regulations that are in place and imposed by the environment, right, where you are operating, the government laws, the environmental laws, right, are followed. So the company must know, for example, during summer months, in the middle of the day, nobody is supposed to work outside in Qatar because it's too hot. Labor law says you cannot put somebody between 11 o'clock and 3 o'clock or something like that outside because it's too hot, right? Doing that violates the law, right? So there should be an internal control in place, training the manager, making sure that the employees are not outside, etc., etc. Are you following? Paying the employees an adequate wage, making sure everybody who's working here have valid visas, work permits, etc. So all of these are government laws, right? I'm giving you examples in a particular field, but there are other laws, how to dispose of your waste, right? Non-discrimination policies, all of these must be maintained. So the company must have procedures in place that follow all of this. So internal controls are in the company handbook, and they ensure that everybody is fairly treated and no laws are violated. Are you following? Okay. There are 5 components of the internal control. The first one is control environment, which is where you're operating. So, for example, we are in a controlled environment, we're in an education institution, for example, a Qatar University, and we need to understand the environment, what we're dealing with. We're dealing with students, right? We're dealing with young minds, and we're dealing with the future of our country, right? So for every company, there is an environment under which the controls are placed. So understanding the control environment, okay? And it's different for different companies, and we could have an entire chapter discussing this, but you get the general idea. Following that comes risk assessment. Risk assessment is following the control environment. For example, if you have an environment where it is very dangerous to work without a hard hat, right? In the construction environment, one of the risks is something can fall on your head, right? And you could get injured severely. So there is a risk. Are you following? So like that, you assess the risks. There are different types of risks in hospitals, in jewelry shops, in construction, in coal mining. It's different types of risks. Based on those risks, you design the control activities. So for example, there is a risk of something falling on somebody's head. The control activities, you must wear a hard hat. They say, you know, sometimes you find it says hard hat area, meaning if you want to enter this area, you must wear a hard hat, right? You will see sometimes in the hospitals, before the patient's surgery, and the doctor asks and verifies with the patient exactly what the surgery is going to be, right? So sometimes, you know, it has happened that you're supposed to operate on the left leg and you operated on the right leg. It has happened. So the doctor comes. There is a risk of this happening. The doctor comes and the doctor says, so what are we going to do today? And the patient says, you know, I have a problem in my left leg and we're going to, so the doctor has confirmation from the patient. So this is a control activity. You know, I had my wisdom teeth removed, right, at the dental college. And before, you know, the doctor, it was a big mistake, but, you know, let's not go there. The doctor, there was a student who did that. Anyhow, the doctor came and the student came. The doctor is the teacher. The student is going to learn how to do that on me. You follow? Right? Not a good idea. So now the doctor, the teacher, the professor asks me, you know, what are we going to do today? You follow what I'm saying, right? So, you know, I said, I'm going to get my wisdom teeth extracted. Also, doing all four at a time is also not a good idea. Anyhow, so you see the control, right? The control is making sure that I am here for the wisdom tooth extraction, right? So there are different types of control activities, and we're going to talk about some. I'm giving you examples from something that you can understand. We will move to the accounting environment, right, in just a couple of minutes. And then the control environment, when they're set up, there is information about that, you know, what you're supposed to do, what you're supposed to follow, what procedures are there, what checklists are there, etc., and communicating that with the people who are supposed to take those actions. So for example, you know, there are a number of things that are checked before the plane takes off, right? I don't know what they are, but you see people with a clipboard and a checklist going around before the plane is going to take off. You see them, right, going in and out of the plane. You know, it's clean, the bathroom is clean, the engine is checked, etc. I don't know what they are exactly. I don't have to know. I just have to pay and ride the plane. But what I'm saying is there is a checklist, so it's communicated to those people who are supposed to take care of that, and they go through the checklist. So this is control, so that nothing is missed, because there are a number of things. And then I'm sure that someone checks and signs, a supervisor signs that all of these things were taken care of. And I'm sure it's even more enhanced due to the COVID-19 environment, right? Because now there is a cleaning, and I think there is a video that Qatar Airways sent me that how they clean the plane, etc., etc. So you follow the information and the communication with people who are going to take care of this, the activity. Are you following? And then monitoring that the controls that are put in place are followed. You know, a few years ago, a student, not a student, I think a visitor, was killed in a car accident on campus. They were crossing the street and, you know, a car hit the individual. So I think 4 years ago, something like that. Since then, there is extra control and monitoring of any time somebody is crossing the street at daytime. Not right now, you do not see this, but you will see security guards from a far distance. They will stop the car, right, and let the pedestrian cross the street. The car will stop at a distance. The security guard will go in the middle of the street and stop the car, so this is control, and it's monitored. You know, the supervisors monitor this very, very closely. You follow what I'm saying? Because this is something that we never want again to happen, right? So monitoring and making sure that it is followed, right? You have all experienced the fasten seatbelt sign, and then it's monitored, right? The crew walk, right? The cabin crew walk down the aisle and they check that you have the seatbelt on. They say if you're sleeping and you have a blanket on, put the seatbelt on the blanket so that they don't have to wake you to check. So this is monitoring, right? This is control activity. So every company has many different control activities and so forth. Okay, now with this in mind, with this general introduction in mind, let's jump into our environment, which is the business, specifically the accounting environment. The first thing we have to do in an accounting environment, specifically when we are dealing with cash, we're going to focus on cash because cash is the most liquid asset and it is easy to steal cash if it is not properly handled. The first control we have is establishment of responsibility. You will see in the supermarket, when you go to the supermarket, you will see that each cash register is maintained by a cashier. And when the cashier leaves, if you ever in the supermarket try to notice, if you have ever noticed it, then you would know that the cashier takes the drawer and leaves with the drawer. The new cashier brings his or her own drawer. So whatever the money they have from their sales during that time that they had the cash register. So if they had 10,000 reals in sales, the cash register should have 10,000 reals. You follow, right? So anything over or short is their responsibility, right? So this is control, establishment of responsibility. The next cashier will start from a fresh drawer. You follow? So anything that happens, anything missing during their shift is their responsibility. Are you following? So establishment of responsibility to make sure that only one person is responsible for the cash drawer at a given point in time. All right. You will also see in your receipt, if you go to the supermarket, in the receipt, either there is a name or there is an ID of the cashier that identifies who had your transaction. Look at your receipt next time, any supermarket, you will see either there is a name or some identification of the person who has entered. Usually there is a name. You follow? So later on, if there's something wrong, right? If they gave you more money, for example, mistake, and you come back, right? You're an honest individual, you come back and you say, I was given more money. So they would know that the money that was missing from their account is belonging to Mr. or Miss so-and-so. So they would give them their money back. You follow? Because the general rule is if money is missing during your shift, you have to pay for that money. You follow what I'm saying, right? Okay. Segregation of duties is the next one. So first one was establishment of responsibility. The second thing is segregation of duty. So now here, usually the actual custody of the cash and recording of the journal entries or recording of the transactions are done by two different individuals, right? So the cashier handles the cash, but the cashier does not record the transaction in the books. There is someone else, there is an accountant who does that independently, right? So the cashier has the cash, and the sales are entered into the system, and the total sales are sent to the accountant who's going to enter. So the idea of segregation of duty is twofold. Number one, when two people are counting the same thing, if one of them makes a mistake, the other one is likely to catch. Two people are not going to make the exact same amount in mistake. You follow, right? That's number one. Number two, it is difficult to do fraud when you segregate the duties. They have to come together to do the fraud. It is not impossible, but it is difficult, right? So to convince somebody else to do the fraud, it is difficult to do it. There is a risk. If they don't agree, they might report you as well. You follow? So segregation of duty does two things. One is reduction of error and the possibility of a fraud, right? Reduction of the possibility of fraud. So that's the second one, segregation of duties. The third internal control procedure or activity is documentation. Usually, companies have pre-numbered documents. So every invoice has a number, every receipt has a number, every check has a number, every document has a number, has a serial number. It's pre-numbered, and every single number is accounted. So who does this invoice belong to? Who was this check written to? Every single number is accounted for. There's no missing document. Nobody can steal a check and get away with it, because every single number must be accounted for. Even if there is a check that somebody wrote and there was a mistake and it was voided, right? They did not use this check. That must go into the check register as check number such and such, void. You follow? So when we used to get the check register from our clients, they might sometimes leave a check number. They don't put anything there. So we would ask them, what happened to this check? They would say, oh, I made a mistake, so I didn't use it. So we would train them. We would say that if you have a situation like that, write void or canceled, so that we know where is that check. So every single document must be accounted for, right? Every single document must be known what happened to it. Okay. The fourth is physical controls. So physical controls you can easily understand. Either put it in a physical safe. You can have time clocks for recording time. You have locked warehouses, right? Passwords, fingerprints, alarms, and you remember this thing from the clothing stores, right? This thing that is attached to the cloth, this plastic thing that they have to take out, right? You remember this? Sure, you have seen it, right? They have to take it 3-4 attempts and it comes out, right? So if you go through the security gates with this on the cloth, there will be an alarm. So these are physical controls. Having physical controls, right? Also part of internal control. The next one is independent verification. So, we have somebody counting the cash and you have somebody else recording the cash, and a third person would independently verify and check the work of these two people to see whether their calculations were accurate or not, right? There are reviewers. And when we used to, the financial statement that you see, the procedure for recording the financial statement that you're working on, the source documents, the documents which the client sends for the preparation of the financial statements go to a bookkeeper first. The bookkeeper records the transactions and prepares the financial statements. That's the first layer. The second layer is, it's already segregated because the bookkeeper does not handle cash. the client's cashier handles cash. Our bookkeeper at Horn, right, at the company that I was in, that D is in, the bookkeeper records the transactions. Then it goes to a supervisor who's an accountant, right, who reviews in detail the transactions that were recorded, and then it goes to the CPA, printed copy, who again checks it, but not in as detail, right, the reasonableness before signing. So multiple layers, independent verification of the work that is done. You follow? Auditing is done by someone from an external entity, an independent auditor, right? This is internally inside your company.
What if there's I'm not talking about accounting, but like in general in corporations, there's internal audit.
Internal auditing is a control procedure. Internal audit is part of this, right? So internal auditors are accountants who work for the same company. They go and internally verify, right? But they are not independent. If the company suffers a loss, they will lose their job. The independent auditors are accountants that are coming from outside. They do an independent review, an audit of the financial statements, and give an opinion. They're independent in the sense that if this company goes out of business and suffers loss, the external auditor who does the independent audit will not have any consequences due to that. You follow? The next is human resources control. So people who handle cash, this is a US concept where they bond the employees, which is there is some type of insurance that is available on employees who handle cash, and a company pays this insurance premium and so forth. And if the employee steals or runs away with cash and so forth, and the company suffers loss, there is insurance against it. So this is something that I'm not sure is very common in Qatar or not, but this is a US concept. It's an insurance. It's some type of insurance. It's called bonding your employees, right? And again, we don't want to get into too much details about this because this is, I don't believe this is a common. Meaning pay them a salary, higher salary. Right. So that is a different concept. That is a different procedure, right? That is also internal control as well, right? So you take care of their needs so that they don't fulfill their needs in a dishonest way and so forth. Rotate employees and require vacations. So sometimes you see this guy, you know, he's thinking that if I go on vacation, somebody comes and finds out that I have been stealing, because if they handle his records, they will find that he stole money. So, you know, employees stop missing a single day of work, stop going on vacation. So some companies require that every single employee take vacation, and somebody will fill their role. Also rotating employees, you will see this is very common, even down to the security guard and cleaners, and they rotate. They to different places. They don't work in the same place for many years. They work for the same company, let's say, but they're a security guard here, and then, you know, 2 years from now they'll be working at a bank, etc., etc. So rotating this is very good, because if they're in some, you don't know, you cannot imagine all the things that people could come up with, right? So you rotate them, by default the problem will be handled. And then conducting background checks on employees who handle cash and other employees as well, right? Conducting background checks, looking at the police record before you hire them, or verifying references, etc., etc., is also part of internal control. This is human resource control. Now, after all this, even the internal control has limitations. Because you have limited resource. So when you're putting in an internal control in place, you have to look at what is the cost and what is the benefit. If the benefit is more than the cost, it's a good control to implement. If the cost is more than the benefit, obviously, you know, you're not saving by putting that control, so it's not useful. Also, the human element that is there in the internal control, that is, even after all the procedures in place, human beings can make errors, right? Human beings can make errors in implementing them. So that is a weakness by itself. And then sometimes the size of the business is such that the company cannot invest too much in internal controls. They just have to accept. Or sometimes the size is so big that if you want to put certain controls, the incidents that you're going to prevent is not significant. It's irrelevant. Even if because of this absence of this control, if you lose this amount of money, that amount of money is not something that the company can worry about. You follow, right? This is such a big company, right? So the company knows, maybe $100,000 are stolen by small employees here and there, but the company cannot worry about it because this is nothing for the company. You follow? So the size of the company makes a difference. Big or small, depend. Both could be issues. All right. So that's all we discussed so far. Are general internal controls in a control environment where cash is handled. Now we have a specific, and you will see some overlap as well, but some specific controls that relates to cash receipts and cash disbursements. So cash comes in and cash goes out. Cash is received and cash is disbursed. You have to have controls both ways. The first one we already discussed, the establishment of responsibility when cash is coming in. The documentation where you have each document numbered, right? The invoices and the sales orders and all of those are numbered. And then the segregation of duties, somebody handling the cash, somebody recording. We discussed all of this. All of these relate to cash receipts as well. And then putting the cash in a controlled safe. You will see one of the controls when you go to a supermarket, the cash drawer does not open unless you have a transaction. Unless there is a sale, the cash drawer does not open. So if you go to the cashier, right? Let's say the cashier finished your sale, right? The cashier finished your sale and you paid with card and the cashier closed the drawer. The next customer is standing right here, you're standing right here, you're about to go. You tell the cashier, can you give me change for 100 riyals? The cashier will say, can you please wait? Let me check out this customer and then I'll give you the change. Because the cashier cannot open the drawer. The drawer will open once this transaction is processed. So the cashier cannot open the drawer unless the transaction is processed, which means there is a customer standing in front of the cashier every time the cashier opens the drawer. You follow? So if the cashier does this, the customer is right here. You follow? Right? So the drawer does not open. So this is a control, cash receipts control. Another control I experienced in Baladi, there is a supermarket close to my I don't know if you've been, Souk Al Baladi, this is a supermarket, new supermarket, a couple of years old. The person that puts your grocery in the bag, everybody tips that person. The person goes to the car with you and so forth. People tip them. But the cashier, nobody tips. You follow? Although the cashier is working very hard and so forth. So I thought, why not? So I offered the guy something and he said that I am not supposed to carry any personal cash in my pockets while I am sitting here. So all money I am handling belongs to the company. I put my wallet and everything in the locker in the back, and when I am off of my duty, I will go. So this guy says, sir, give it to me, I will give it to him later. So, if their friends, he said, yeah, you can give it to him, sir. So I gave it to him. Anyhow, so this is the control you follow. So the person does not have any personal cash on him. It's cash receipt control. Following that, cash receipt control, you see there is a procedure, there is a dual procedure of handling the cash and the information about the cash. You see there are two people handling the same amount of the same amount. One is handling the cash, the other one is handling the register tape. So all the sales that take place that you get a receipt for, there is an internal tape in the machine that is adding the sale. You follow? So at the end of the shift, the cashier has the actual cash, and that tape is inside the machine that is locked. You follow? So when there is shift change, notice this next time it happens, you will find, if you are vigilant, you will catch this next time when you're in the supermarket, when the shift is changing, because not all cashiers change the shift at the same time. So you might catch one. What happens? The supervisor comes, right? The supervisor comes and the supervisor has to unlock. So the drawer belongs to the cashier, and there is a tape which records all the sales during that time period. The supervisor takes that tape which has all the sales, right? So the cashier counts the cash, right, and sends it to the central cashier, who will count all the cash from all the checkout counters, right? It comes here. The tape, right, the supervisor takes, and he or she gives it to the accountant. Now you have two people here, one person handling all the cash coming from the cash registers, and the accountant getting all the tapes. These two amounts must match. They should be the same. You follow, right? And usually there is an allowance for over and short, a very small amount, $3, $5, something like that, because of the rounding of sales, right? Because sometimes there is, you will see the cashier, if it is, if your bill is 94 reals and 15 dirhams, right? The cashier will give you 6 reals back when you give 100 reals, right? So there is this 15 dirham, right, that the cashier gave you more. In another transaction, it could be that it is 94 reals and 89 dirham, right? The cashier gives 5 reals. So you lost as a customer 11 dirhams. Let me see, I'm saying lost, it's nothing, but at the end, you have dozens of customers. So because of this, there could be a few reals, 2, 3, 5, 10 reals. So there is usually an allowance. This is called over or short. It could be more or less, and there is an allowance, right? You follow? There is an allowance for that, and based on this, the deposit slip which is prepared for the bank. So the deposit slip lists the money that is deposited into the bank, and then someone else would take that deposit slip which has the cash that is deposited into the bank, the date, the account number, the amount, and so forth, and then the money is taken and deposited into the bank. This is done more than once daily, right? More than once daily. The store does. Somebody takes the cash and deposits it in the bank, right? There's deposit slip, and the deposit slip, different types of deposits. There would be credit card slips that are deposited, checks, cash, etc. So this is deposited into the bank more than once daily. Okay, so these are cash receipts control. The next, what we have is cash disbursement controls, and both cases, it says here, if you're paying using electronic methods or checks and not physical cash, the control is tighter, right? You don't have to handle cash, and you will see many companies and many organizations are moving to non-cash transactions. You go to any health center, for example, they don't take cash anymore, right? The health centers, Hamad Hospital, if you go, they will not, Murur, they don't take, Al Ali Hospital, they don't take cash, right? So it's an automatic control when you don't have to handle cash, because the cashier does not handle any cash, it's all electronic. Okay, if you do have to handle cash, there are two things that are listed here. One is the voucher system and the other one is petty cash. We're going to talk about both of these in some detail. So voucher system, remember, and petty cash, it will come in just a few minutes, inshallah. We'll take a break in a few minutes, inshallah, also. The disbursement controls, again, has similar controls like the receipt. You have a establishment of responsibility. In this case, when cash comes in, cashier, when cash goes out, you have the treasurer. Remember last week I mentioned there is treasurer. Treasurer is directly under the finance VP, right? The finance VP or the controller. Who's the controller, remember? The chief accounting officer, right? I know you didn't study. We discussed this last week. Treasurer is the person who handles the money that is going out, right? Any money that is paid, it has to go through the treasurer, right? Same issue here, pre-numbered documents and segregation of duties. So somebody's actually handling the physical cash and somebody's recording. So going in or coming out, handling of the cash is separate from recording of the cash transaction, which again segregates the duty, increasing the possibility of catching the fraud or decreasing the possibility of fraud and decreasing the possibility of errors. Very good. Same, again, similar controls here: independent verification, human resource control, and physical controls, right? Same procedures, general procedures, but we have two specific things that are done in the cash disbursement. One is the voucher system, the other one is petty cash. The voucher system is a series of approvals before a cash amount is paid, right? A series of approvals for a supplier or to anybody before the cash is paid. So for example, if a company orders something from a supplier, the first document that is created is called the purchase order. A purchase order is sent to the supplier. When the supplier sends the goods and it's received, the company prepares something called a receiving report. So the purchase order is order for the goods. The receiving report is proof that the goods were received. The third document comes from the supplier, and that is the bill, which is called in accounting terms invoice. Before the payment is made, before this invoice is paid, the purchase order, the receiving report, and the invoice, they are matched, right? If you order 10 computers and you receive 10 computers and the invoice is for 10 computers, approved, pay for 10 computers. If you ordered 10 computers, you only received 8, and the invoice is for 10, well, you're not going to pay for 10 because you only received 8, right? So it is prepared by someone and then it goes through approval and signatures so that the cash going out of the company is not as easy as somebody writing a check. It goes through multiple people, multiple layers. It is fast, it's efficient, but not one person can take money from the company. Huh?
I have experience with this, like, because I'm organizing trainings for the company, so we're working with this vendors. So when we do the training, we have to get a purchase order number. And then we make sure that the training is complete, we receive their certificate. We have to get approval for the purchasing order from the head of training. And then we have to put the purchasing order and the certificates and the approval and send it to the Treasury Department. That's process everything. So all the.
So did you just start this, or was it in?
No, for me, I'm just introduced to it now because the person actually is off, so I have to take that responsibility.
Find something that they did.
I'm relating so much to this.
Right.
It's a struggle.
So it is. It can be efficient, and it is efficient. I know for Qatar University it is extremely efficient because we have an ERP system. If you have an ERP system like Oracle or SAP, if both the supplier and the buyer use the same ERP system, it's like that. You follow, because you can see each other's transactions. You follow. It's very, and you can, if you trust and so forth. If it becomes manual, it can be a little bit, Anyhow, so you understand the idea of the voucher system, right? Now we will talk about the petty cash. We'll talk about the petty cash at the end. That is the second one. Now have the next concept is the use of a bank and a bank reconciliation, and I think this is a good place to stop, inshallah, and take a 10-minute break, and we'll continue from here, inshallah.